This is a Momentum Media production.
Inside Commercial Property with Rethink Investing.
Australia's largest and most comprehensive podcast covering all things commercial investing.
G'day, how you going? Phil Tarrant here, co-host of Inside Commercial Property with the man, Scott O'Neill, Director, Rethink Investing. How you going, Scott? You well?
Yeah, very good, Phil. Very good. Yourself?
Yeah, it's all right, mate. Good to see you. It's spring's in the air. The spring selling season is just around the corner. A lot of people have been chatting to me about this, thinking what's going to happen with spring selling season. And the big question for me is whether or not that actually exists in commercial property. We're going to have a chat about that today, Scott. Other things have been on my mind, and we've got a special guest coming into the chat a little bit later on around using the right lawyer for commercial transactions. Commercial transactions are often very different to a resi transaction. I think a lot of people make the mistake where they think their local suburban conveyancer could probably also conduct a commercial transaction. So we'll have a bit of a chat around that a little bit around, Scott. But hey, I was chatting with my accountant the other day, and he said that we, as in me and you, and this particular podcast, Inside Commercial Property, is behind every single property investor now wanting to invest in commercial property rather than residential. What do you say about that?
Look, I think we're a very small part of it, but the market is definitely helping us. This interest rate rise scenario, it's not good for residential property. Look, arguably it's not great for commercial, but people need more cash flow now. Like, the interest rates are higher, so by default, people are looking for other options. And at the end of the day, there's a lot of cash deposits out there, and equity positions are quite good. And despite what the media headlines are saying about, confidence levels been low, which is the case, but the investors have money and they do want to invest, and putting your money into a term deposit is just simply not an option if you want to stay ahead. And I think we're just in the right place at the right time. And yeah, look, we're flying. We're very busy at the moment. And, people that reach out to us know there's waiting lists to find a property. But yeah, look, it's because the product is good. People want a high yielding commercial property. And, like you've recently purchased, I'm in the process of buying again myself. It's a good time to buy. And yeah, look, commercial property it's a lifelong investment. You're not just buying it for the next year. So whatever the interest rate right now is, it's kind of irrelevant, because in 10 years' time, it's going to be a different interest rate and you're going to get a different rent value. Your return will change over time. So yeah, if you can, you go. Well,
this is, and I like your sense on the current market right now. And, we've had a number of interest rate increases. They're banking on another one in September as well, another 0.5 or 50 basis points. So we know we're in a rising rate environment, and that obviously has impact on both residential and commercial markets. But a lot of people say to me, Scott, that number one, because we do this podcast, a lot more people are asking a question of commercial property and considering commercial over resi. But has the shine come off commercial property now with these interest rate hikes? Because you talk about good yields and good positive cash flow inside of commercial, but as that interest rate keeps coming up, it keeps just gnawing away at your positive cash flow, which may put some people into neutral cash flow or negative cash flow on commercial assets. What do you say to that? Just hold the line? Yeah,
what I do encourage people, reach out to us, because I'm going to do a little news article on basically a breakdown of the numbers, and I'm going to use an example. It's going to be a 5.5% yielding commercial property for $1 million based on a 4.5% interest rate. Now, that might sound like it's quite a marginal deal, but like the question I'm going to put to them is, would you invest in this property in 5 years' time or buy it now based on the same cap rates with a 4% annual increase in the rent? And believe it or not, just by delaying this decision, number one, you're going to lose out on $152,000 of passive income in 5 years. This is assuming you've used a 70% loan at 4.5% interest only. So you've lost $152,000 in income. But interestingly, that cap rate with that 4% increase means the property is going to be worth $170,000 more in 5 years' time as well. So just by delaying this decision, it's going to cost $330,000 or just about $330,000 extra based on 4% growth. Now, that might sound all a bit hard to understand, and it is, because you've got to understand how money sort of is really affects itself over time with commercial, because the cap rate, as that rent grows, so does the cost of the property. So the answer is, if you're getting an income, you still got to buy, because it's going to cost you more next year. And the cap rates have already compressed a bit. So there's the opportunities back in the market, I think. And unless you really, you just got to get your head around this. Like, if you don't truly understand the numbers, you can't answer this question. And you've got to break it down year by year, which I'll show you. So if anyone wants to see this, just email info@rethinkinvesting.com.au, and then we'll send you this article as well, which I'm halfway through.
It's good. We wait with interest. And Scott, for our new commercial investors, you spoke about cap rate there a couple of times. Can you just explain what that is?
Capitalisation rate is a form of valuation. So the rent value on a property, assuming let's say it's 60,000, the 60,000 at a 6% cap rate equals $1 million for the property. Now, if the cap rate of that market's 5%, that means you'd pay $1 million for 50,000 of rent. One more, if it was a 4% cap rate, 40 grand of income is worth $1 million to the market. So the higher quality of the property or the area will dictate the capitalisation rate. So a really high cap rate, like 10%, so that means 100 grand of rent equals a purchase price of $1 million. You'd normally associate that with a very regional, risky type property. So maybe it's an old tin shed in a 5,000 or less person town. You'd need a very high cap rate because the re-letting of that property would be quite difficult. So every market, every asset type has its own capitalisation rate. So you've got to get your head around that before you invest. Like, I know, Phil, you invested in industrial in Perth. You bought at a mid 6% cap rate. The market there is probably 6% or 5.5% cap rates down there at the moment. So you bought better than the market. And that was just, off-market purchase type stuff. So the opportunities lay everywhere, and the capitalisation rate can allow you to identify that.
Okay, so it's a good description there. I hope everyone enjoyed that. Now, so I'll give you a sense for the market. We all know resi markets have come back somewhat. Some property commentators are already calling the bottom of the market, or the near the bottom of the market on the property clock. They're getting towards 6 o'clock on that. What's your view of commercial markets as we sit right now? If you give us a quick sense at the sort of capital city level.
Yes, so I'll break it down into asset classes, because the capital cities are all kind of running somewhat similar. Industrial, the nation has recorded an all-time low of 0.8% vacancy rates, which is actually the lowest globally recorded vacancy rate for any country. So that's pretty enormous, to be honest. That means that you're going to see rapid rent growth in industrial, and I think it's a really good sign for capital growth over the medium term. What that'll eventually do is all these rents rise, and they're going to rise much faster than people think. It's going to raise the value of these assets. And believe it or not, this came down from 6.9% in 2019. So it dropped from 6.9 to 0.8 because of COVID and everything else that's happened in the world. So that's going to build in price growth. Eventually, this is the next stage of the cycle, is you're going to see builder margins return. Like, obviously, costs of building very high, but you'll see more supply hit the market at some stage when the returns make sense. So that's something to keep an eye out on. We're not there yet. Retail, unfortunately, there's not really good data out there, because the big major warehouse, the CBREs of the world, they just look at CBD areas, which is obviously a skewed section of the economy. They're saying that the vacancy rate is 12.9%, which is it is increasing. It's probably up a couple of percent from what it was. But that's CBDs, and we know that regional and suburban markets have actually gone quite well since COVID. So, yeah, there's sort of figures there that you can't really rely on, because, like, we're not buying much CBD stuff. We help clients into the suburban neighbourhood shopping centres and regional areas, and they're all going very strong. And that's a similar type commentary for office markets. So they are still, the vacancy rates are quite high. They're probably double what they used to be and in the CBD areas. But again, suburban markets or regional markets, they're doing quite well. So we're seeing price growth happen. The lowest yielding assets are the ones that have suffered the highest price drops. And And they're very small drops. They're nothing compared to residential. It's almost like the stabilization of the growth has happened. Because prior to these interest rate rises, it was a bit out of control. So that's all settled down for the last 6 months. And we're seeing basically it's just like deja vu. It's just like the same things happening each month at the moment. We're not seeing any drop off from our investor levels. And basically investors are just still looking for good deals, but they're not going sub 5% for any deal really at the moment, which is reflected in some of the auction warehouse, big companies that we're seeing the sort of their low yielding, KFC type deals. They're now going at a slightly better price than they once did.
Mm. So if you had
sort of the roundup,
if you had a couple of $1 million, where would you put it today?
Well, look, personally, I've just put a shopping centre under contract myself. So look, I'm quite bullish on well-placed retail over the medium term. I think industrial is the safest bet, but you're going to pay a price to get in there. It's because the confidence levels is just so high. So you're not going to do wrong by putting your money into industrial, and good retail, same thing as what there. But yeah, if you had a couple of million, I'd probably look at retail or industrial equally and let the deal dictate your final decision.
Okay, well, no doubt, if you're going down that pathway, you need a good lawyer to help you with the transaction. Big part of the due diligence process in commercial, which is a lot more onerous than inside a resi property. It's not too many things that are outside of the norm with residential investing. So your local suburban conveyancer or local firm can normally look after you. But when you get into commercial assets, Scott, it gets a bit trickier. There's a whole bunch of different things you need to be considering. So a few more loopholes to go through, and also there could be some hidden flaws in commercial assets that you might not be aware of, and they might be structural inside the building, but they might also be structural inside of the contract as well. So you need to be able to dig down deep into these different asset classes, making sure you're making the right decisions. And you've seen it time and time again, Scott, people getting the wrong lawyer to help them with a commercial transaction. What's the worst that can happen if they do that?
Well, look, they just miss basic things. And yeah, look, it's been one of my biggest gripes in my career as a buyer's agent, like working with lawyers that don't know what they're doing, because everyone has their family lawyer or, the guy that's a little bit cheaper. And this creates a lot of problems as a buyer's agent because you need a lawyer to sort of work with you to help identify issues and, almost be the safety net. Like, we don't want to be the lawyer. We're not like, we're here to do all the due diligence, but like if you've got no one looking over your shoulder because they're incompetent or they're brand new at the job, it's worrying for the client, because the lawyer solicitors will represent the client. That's their job. They don't represent the buyer's agent. And yeah, we previously worked with many, some cheap conveyancers out of, Sydney and Melbourne who, they kind of fumble on the job, and then you're crashing deals last minute because, they've missed things. So worst things that can happen is they don't understand a lease properly. For example, you might see an outgoing of land tax saying it's covered, but in the notes of the law, in the lease, it's saying it's not covered. So it's a contradiction in the lease. So imagine if it was on a 10-year lease and there's an extra $5,000 of costs you've got to account for every year. That's got a huge impact on the value. So lawyers, if they miss something like that's very bad for the client. Not getting strata reports, like it's just there's a million things you could sort of consider, but not understanding the lease is probably the biggest one. And and then obviously there's different implications with different states. Like if you sort of overshoot your due diligence period, or you get locked into a deal when you're not ready, there's other issues that can pop up and cause the client problems.
Yeah, and the good thing with a lawyer is that they should be able to spot stuff early, and stuff that you can spot inside a contract that you might not be aware of and or might not have been presented in the most favourable way as you go through your due diligence could be turned into an opportunity rather than something that you need to worry about. And that could be negotiation around a particular point. You might be able to get different terms. You might be able to change the price. There's a whole bunch of different ways you can frame it, or you get to choose whether or not you want to proceed with the transaction. The flip side of that is that at the 11th hour, something pops up and it just scuppers a transaction. Everyone spent a lot of time, energy and effort to get something done. So make sure you got the right lawyer working with you. And to your point, Scott, this is not beating up the very important work that property conveyancers do. I just think you need to make sure that you operate within your lanes and you use the right person to support you in any transaction. And, having recently bought commercial property and have bought also a lot of resi stuff as well, it's a very different tempo in the negotiation on commercial property. It's a lot more business-like, a lot more ruthless as well. So if you haven't got the right lawyer with you, you're probably going to lose control of the purchase and be on the back foot. It's the last place you want to be, isn't it?
Yeah, exactly. And it took me about 5-6 years of working to sort of land on the guy I use, which we'll introduce now, Sam Saad. Like you said, they've got to be ruthless in the negotiation and also like negotiating post sale as well, like because you need to negotiate against your tenant down the track as well. So when the leases come up, they might play hardball, and you need the right guy in the right corner. And I think I found him. So were you happy to share him with everyone else, Sam Saad? I actually used Sam's firm as part of my most recent transaction, which I spoke about on this particular podcast. Sam's from Rethink Property Lawyers. He also runs. He's got a firm with myriad different sort of capabilities. Sam, welcome to the show. You must be okay if Scott uses you.
Yeah, that's right, Bill. Thanks for having me on board. Yeah, look, Scott's been great over the years, and I've learned a lot from him, and I think vice versa on the legal side of things. So it's been a pretty good relationship, especially with him and a lot of his clients.
Yeah. So talk me through being are you a commercial property lawyer, or are you a lawyer that does commercial property, or you have a firm that does a whole bunch of stuff and you also have a specialization in commercial property transactions? Tell us a little bit about it.
Yeah, so look, I'm one of the partners at Clinch Long Woodbridge Lawyers, which also has effectively branding aligned up with Rethink Property Lawyers. And effectively, our Rethink Property Lawyers is an arm that works a lot with Rethink Investing. And effectively, we're an independent firm to Rethink Investing. However, we've worked with them for such a long time that we've built processes in place that are tailored specifically to their clients and their types of deals. But in addition to that, we basically add a layer of expertise to what we do in that, the firm does a myriad of things, from property, estate planning, family law, and other areas. But my specialty is commercial property. And that's one of the spaces that I specialize in. And, being able to work with someone who knows your processes helps out in terms of streamlining that process for clients and making sure that they have a smooth as possible process, and also a in-depth understanding of the properties that you're going to go through when they're buying things.
Yeah, look, I had a pretty good experience with your crew recently, and I was sort of reflecting on it the other day, thinking I probably wasn't necessarily the best client. I was hard to get a hold of. I was slow in decision-making, probably didn't pay my bill on time, all that sort of real good stuff. How can you be the best, from your view, how can you be the best commercial property investor dealing with your lawyer? What's the secret? What's the secret to success there?
Look, the key is being able to work with the whole team together, and main thing is obviously being available for your client. So, if you're there, that's a good start. But going from that to just being available to have contact and relationship with Scott, his team, ourselves, and being able to have an open and transparent relationship, so you know exactly what each person's doing from their side of things. It's very easy for some buyers to think that, Rethink Property Lawyers and Rethink Investing are one and the same entity, but we're not. We focus on different things. Rethink Investing focuses on the commercial experienced side of things and the numbers and getting you the right property in terms of, the numbers that they present, the outcome, the return, so on and so forth. From our point of view, we check all the legal side of things and make sure that, all your T's are crossed, your I's are dotted, and that everything's covered from a legal viewpoint to make sure basically your lease is in place, it's registered, it's got tenure, you got the right tenants in place in terms of, them not being bankrupt, looking into deeper things with counsel if necessary, and going into all that deep legal due diligence to make sure there's no red flags that, vendors got potentially covered up somewhere in a contract or in lease terms. It's very easy to mix all those things up. To an eye that has many years experience, it could be easy to pick up, but for someone who doesn't have that eye for detail, it's very easy to glaze over and miss small things, some things like outgoings and whether they're included or not. What's covered in outgoings, that level of detail, I think, is important to see.
So do you still get excited reading through legal contracts? Because I've got a stack of them on my desk, and I keep getting pestered to look at them, and I don't want to look at them because I hate
I love them. That's
contracts, and I should never have been a lawyer, but you obviously enjoy it, right?
Yeah, live and breathe it. That's what we do. It's more so the relationships with clients as well that you build along the way and helping them get through that and understand it. And it's funny, you see some clients that have come back to you for 2, 3, 4 different transactions. And each time they come back, they're more educated on it, understand the process, and it becomes an easier process as you go along. Obviously, your first one that you go in is very different to potentially previous residential properties where basically, you find a house, you fall in love with it, you buy it. It could be your home. If it's an investment, just the rental numbers need to stack up. But with commercial property, you're dealing with a lot more robust, detailed issues such as different businesses, different tenants in there. It's not just your, a mum and dad tenant that are looking to just have somewhere to live. It's a more complicated tenant or buyer or vendor that you're dealing with, and there's a myriad of issues that you need to look at when you're looking at those things. So no two transactions are the same. They vary. It may seem like the same contract across the board, but there's a lot of differences across each property that you buy.
So what's your most memorable contracting journey for a commercial property for being really, really bad, or the worst outcome, or the worst thing that happened that went wrong? Any real memorable moments there?
Yeah, look, there's different things that go on every day, but the most gut-wrenching thing is when we do so much work for a client and last minute something happens with finance, or there's a red flag that pulls up at the end that doesn't work. We've had some shopping centres, in particular recently, a shopping centre which had about 15 to 16 tenancies, went through everything in detail. We're going back and forth, and just basically last minute we couldn't get through with finance on it. We tried to turn it in different ways, and there's many ways you can skin a cat, but we still couldn't get it over the line. And sometimes that's frustrating for a client. But, the advice that we had to give at the time was it didn't work because of certain things, and those red flags didn't allow finance to go through. But that's what we're here for. You'd rather lose, 15 grand or 20 grand in legal costs after covering off everything on an asset that's about $17, $18 million, rather than being stuck in it and, losing your deposit, which is potentially close to 10%, which could be $1 million or $1.5 million, to a vendor who might play hardball with you and not allow you to get out of the contract for whatever reason. So we had to take all precautions. That was something that was pretty big, but they vary from contract to contract. So I can't tell you we go through that many at a time. So it's, yeah.
Yeah, and that's a good point. A lawyer in many ways, but personally, I hate dealing with lawyers. I can't think of anything worse. They do a great job, but the only reason why you have a contract normally is in case something goes wrong, right? It's not the good old days where you do business on a handshake. Lawyers play a very important role in all transactions, particularly commercial property transactions. That's why you need to find the right lawyer that you can work with, that gets how you work. I could be a trusted partner, knowing who they serve, and that is the buyer. But it's the cost of doing business, dealing with lawyers. If you're going to participate in the commercial property, you need to get used to the idea of paying for lawyers for the very important work that they do, even if you're not successful in buying it. I reckon that's a pretty good insurance policy, 15 grand, 20 grand, than blowing your dough on a $10 million asset. It pales into significance at decimal points, Sam.
Yeah, that's right. And look, I say to people, it's sometimes these transactions are the biggest things you spend on in your entire life. And the thing with lawyers and conveyancers is that we're not regulated by anything in terms of costs. Everyone has their different overheads, different pricing, different experience levels. So every lawyer is going to charge something different. Some are going to be cheaper depending on state-based. Some are going to be more expensive depending on experience. And ultimately, when I go to professional relationships, if it's an accountant or a lawyer or a broker, I would normally go off recommendations. And despite having to pay, additional costs or a little bit higher costs sometimes, that you're going with someone you can trust. There's a relationship where they've been through the process before. And, you might spend $1,000 extra or $1,500 extra on, a lawyer that you've been referred. But in the long term, let's just say you miss something that's 20, 30, 40, 50 grand down the track that's going to cost you, then you're going to be spending a lot more on legals trying to fix that problem up. And you're going to be paying potentially that issue of 10, 20, 30 grand. So if you'd spent that, maybe 1,500 or 2 grand extra earlier on in the piece, it's money well spent for such a large transaction. And most of the commercial properties that we're dealing with are at minimum, $1.5, $2 million. So, $3.5 grand is normally $3.5 to $5 grand is the legal cost on that space, including, disbursements and searches and everything. So if you're spending that amount of money on such a large asset, it's not a lot of money in the scheme of things. If you're going to sell a property, you're going to have sales agents costs. They're usually 1.5 to 2% or something around there in terms of the price of the property. You got your brokers who charge you a percentage as well on the value of your loan. If you've got, a $2 million loan or $1.5 million loan, there's a percentage there. So it's all adds up, but it's all for your protection and, to make sure that you've got everything right from day one so you don't have to look at it down the track.
It's a good point. And a good lawyer will de-risk your investment for the future. So if you choose to sell it in a couple of years' time, if you have to liquidate it, then anything curly in a contract that you might not have picked up, the next purchaser may pick it up. So at least you've got that knowing the asset that you have and you can, plan for the future as you need. How do you know, Sam, if your lawyer's charging you too much? Is it just one of those things you got to take a bit of a sense check on?
Yeah, look, first of all, you got to trust who you're being referred on from. So, you no doubt that person's dealt with that person before, knows how they operate. There's no right or wrong process as to how much is done. But in terms of a sense check, clients are always more than welcome to ask around. But I can almost guarantee clients who in one way or another will find a cheaper person. You could find someone who probably does it for $1,000, but it doesn't mean necessarily you're going to get the same level of service as someone who's going to charge a little bit more. And you'll generally find us at the higher end of the mark, but that doesn't mean, the service that we offer in the detail. We've had a lot of clients who have come back and said to us, your DD process is super detailed and goes into a lot of information that we never expected or, our previous lawyer didn't cover this off. So you make sure that you get your money's worth in terms of what you're spending. And we don't want to leave ourselves exposed in terms of, what the outcomes could be down the track and what clients may experience at a later point.
I've always found leveraging, if you have one trusted partner as part of your property investment journey, whether it's resi or commercial, tapping into their network and their professionals that they refer work to is pretty good because everyone knows everyone knows each other's processes. It's a lot less tension or friction in those transactions. And if you're referred on to someone else as at a service thing, you're probably going to get looked after because there's sort of long-term relationships there in place and referral partners typically don't want to burn each other. So that's a really good way to operate. How is it going to be a point in time, do you think, Sam, when robots take over commercial property transactions? I can't see it any point in time because they're pretty complicated things to negotiate, right?
Yeah, mate, definitely. If robots did, I'll make sure I own one of them, but they definitely don't. I don't think anything can replace personal advice. There's so many different things that go into commercial properties and whether you need to make a decision on something, it's never black and white. There's so many different factors that I don't think advice can ever be changed. Contracts are contracts. They're all similar in some way, shape or form. But what you find behind that contract that fronts you up in the first place is what actually counts. And that's where you need to look into things and understand what's happening, know where to dig, know which points to press, which points not to press. And I don't think experience can be replaced in any way, shape or form in the future. So, and, robots are not going to be communicating with Scott's team down the track. So that's another part of it. If there's something that comes up, I can always pick up the phone, either make the client's life easier by having a chat to Scott or his team about anything, or alternatively, understanding issues before I have to go to the client and worry them about certain things. That could be a very simple solution or answer to something for the way it is. And that's why relationships are important.
So, Scott, how quickly or how far through the purchasing cycle do you need to bring a lawyer into a commercial property transaction?
Well, day one. So you need the solicitor to look over the contract prior to signing. So I know the process we have with Sam and other lawyers, if the client has it, is we don't want them doing a massive, costly legal review of a contract if it's got a simple due diligence contract at the start, because you can do a quick review of it and you can pull out of the contract for any reason if that due diligence clause is all-encompassing. So that's a way of kind of saving costs if you're sort of 50-50 on the deal, if you just want to kind of lock in a price, and that, using a contract is one way of negotiating as well. So you've got to be swift. You can't wait a week or 2 weeks to get a contract reviewed if there's 3 other people going for the property. So getting a lawyer in quickly to do a quick review at the start can allow you to purchase a property better. And, like you mentioned, we've all got our specialties. Mine's negotiating and finding properties, not legal. I don't want to look through a contract, and and that's where Sam can quickly come in and cover my weaknesses, and then I can focus on what I do best. And then once it's under contract, the lawyers will get into their work. Like, I'll use my experience when I'm purchasing a property. The thing I'm most interested in is the legal lease review. Like, I've seen 10,000 word emails through Sam's team just breaking down each lease to the granular detail, like, what director guarantors are in there, what percentage increases, how do they tackle the mark review, what are the make good provisions in the lease, like, and there might be 10 different leases or 20 in a property. You could imagine the volume of work it's included in that. And as a client, when I'm looking at that, I don't want to read all of that because I'll be up all night. I don't have the time. So I'll literally just send an email or call Sam and say, look, tell me what are the red flags in this. And he'll actually highlight them at the start and say, look, there's a issue with lease 2B, this one at, number 7A, that there's got an issue. They're missing bank deposits there, or there's a red flag with his credit history. Like, all that is uncovered. And then I can use that as the due diligence and go back to the agent and say, we're not happy with that. We want that fixed up prior to settlement, or it might be a complete deal breaker and we just crash on the basis of what Sam's found in the legal lease review. So that's normally, second week of due diligence or third week. So it doesn't come week one. You kind of want to just check the numbers before the legal team gets stuck into the legal lease review. So first thing I check is, do the numbers stack up? So we just check bank statements and check the return is the return. If it is, the building report will come back at the same time as well. So the building report's cheap, $500, $1,000 for a big property. It's not a big ticket item. So you get the numbers and the building report sorted first. If that looks good, the legal lease reviews will come through, and that's huge for the due diligence. And if all those things check out, you're probably onto a winner. And then after that, it's all your usual lawyer stuff, checking easements and basically preparing for settlement and balancing the books.
Yeah, what Scott spoke about there, our listeners, is really important. That's using legal contracts or the sale contract to control a property. And depending on what state you're in, there's different ways and works. But, there's a lot of competition for a property. You want to be able to control that property. So it means signing the contracts, safe in the knowledge that you've got get-out clauses normally at stages of the contract. And a lot of really smart buyers use this really well. They might be controlling 3-4 contracts for properties in a similar area simultaneously, and just looking for holes or looking for ways in which they can push the price down, knowing that there's different points in time they can actually get out of the transaction. So really, really smart play if you can do that. A lot of people get worried about doing that, though, Scott. They think as soon as you ink a contract that you've got to proceed with it. So the key things to be looking at really is those sort of steps, get out of the contract clauses, which normally happen at finance or at pest and building, different areas, part of the DD process.
Yeah, exactly. And look, you got to be careful. You don't want to burn bridges by crashing too many contracts. But you're right. Like, it is a major advantage if you can use that. You can basically outgun other buyers, and we've made a career out of doing that. And we know the checks you got to do initially. You quickly call councils up. You have an agent you trust as well. Like, if it's a dud property, you'd like to think the agent who knows the property best will be very honest with you, and we work with the honest ones, and the ones that have burnt bridges, we'll never work with them again. So, like, we've got a big blacklist of agents that we've effectively boycotted because they try to send properties through in hide numbers, or they're just not diligent, which kind of then costs the client money and frustrates us. It's just a big relationship nightmare when that happens. So good thing about commercial is it's very rare because, like you said earlier on, Phil, there's a lot more business nature to this. Like, there's not much emotion. Everyone, like a good commercial agent, knows the numbers sell the property. So every good buyer, especially a multiple $1 million property, they're going to check the numbers to the decimal point. So it's going to come, it'll be unraveled 3 weeks into the due diligence regardless. So it's best for all parties to get the numbers right from day one.
And maybe lawyers don't have much of a pulse, Sam. What gets you excited these days when you're working on a legal contract? I know a lot of lawyers, by the way, so I'm allowed to give you a hard time. When you get home and go, it was a good day today. What's a good day for Sam at Rethink Property Lawyers?
Oh, that's a tough one. They're all good days, but I guess when you have as least hiccups as possible for clients, There's so much that goes wrong all the way along. But, a lot of the time clients don't see that. We're always fighting in the background because that's what we're here for. We don't want to send you every email and just say, let me know what you want to do. A good day is one where it goes through smooth, no issues, have to change up contracts or stamp duty issues, or something's come up with council, something that's a hiccup for a client, finance issues, all those things, we have to run back and forth for a client. But, that's part of our process. That's what we're there for. Make sure we vet out all the things and make sure it all runs as smoothly as possible for a client. So what they see in terms of correspondence just happens or looks easy. That's what we get paid for. So, but for me, there's always a new transaction, something different happening. It's never 2 days the same. And that's what keeps it going, I guess, in terms of doing all these transactions.
Yeah, it's a good point. A good lawyer will be a sort of buttress you from a lot of the noise that probably happens in the background. And that's part of the service. But from a mindset point of view for commercial property investors, Sam, you've got to expect things not to be easy or things not to be as smooth as what you think it would be. I think a lot of property investors, if they're not very experienced, think it's, there's not going to be much angst or there's not going to be many what ifs and problems and issues. Like, that's just the nature of doing business inside of commercial property. Is that a fair call? How would you say, what's the best way people investors are frame going into a commercial transaction, just going, well, it's probably not going to go exactly as you pan out, so be ready to be a bit nimble?
Yeah, absolutely. Look, nothing ever goes smoothly, and if it does, it's almost a surprise for us as well. I think the way you got to go into it is that, a lot of people go into building contracts and, you're building your new home, and along the way, there's going to be variations because there's things that you don't know when you go to buy a property and you want to build it. There might be stone under the property that you have to knock out, and, all of a sudden you've got $100K of extra costs or something that you didn't expect, and now you can't do, this half of the building the way you wanted it. So same thing with property when you're buying commercial property. There's going to be things that we pick up, things that you didn't know when you're transacting. For some people, they go in with the mindset that it's very similar to residential, where your conveyancer goes in, you buy a property, they do everything in between, and they'll contact you closer to settlement when you're ready to go. With commercial, we need to have contact often with clients and make sure that you're aware of what's going on. There'll be back and forth with each lease, with each part of the property that you're buying. It seems like a straightforward contract. They all look the same, but leases are all different. There's no regulated leases across each state. So anyone can use any lease from anywhere. You can get a lease that's 10 pages or one that's 100. And that's your cornerstone of your asset, and we need to make sure that that's right. So going into it, making sure and thinking that there's going to be hiccups along the way, that's normal. That's what we're here for. That's what Scott's team's there for, to make sure that we try and guide you through these things and navigate as smooth as possible to get you through to the other end. And you know what? If a property falls through and it costs you some money, it is what it is. It's better that you've picked that up rather than not have picked it up and be stuck in it with someone who wasn't able to advise you on that. Sometimes clients, as Scott said earlier, will do the DD, we'll review it, do the due diligence in that time frame. We'll say, okay, the contract's fine to sign because there's a 28-day due diligence clause. And then after that, clients sign, they get into it, and then during those 28 days, we get started. And so sometimes that can take 2 or 3 weeks for us to give the advice to the client. And clients will come back to us, potentially 3 weeks later, look, my finance hasn't gone through and I can't go ahead with the property for whatever reason. And clients will say, okay, so, for us in the background for those 2 or 3 weeks, we've been working pretty hard to get all the advice summarized into the shortest form as possible to give it to the client. And there'll be usually an upfront like a cost for the client, even though they don't proceed. But that's because in that time frame, our role is not to give you the advice as to whether you should go ahead or not. We still prepare and give everything that you need to do to be ready, but there's still quite a bit of work that goes into that in the background. And, you might get a 2-page email that summarizes your lease or half a page, but that's taken a while and experience for us to be able to give clients that detailed advice in such a short, succinct format. So yeah, at the end of the day, what you see in front of you is experience that's led to allow us to do that.
And we've spoken mainly about being on the buy side. You also represent the vendor in commercial transactions. Is that largely as easier, more straightforward process, acting for the vendor?
I think it is definitely. When you're on a vendor, they know what they're selling, and you've basically got to put a document together and say, this is what you're selling. And a lot of the principles of buyer beware in commercial property apply as well. So it's up to buyers to undertake their due diligence and understand the property and understand its position. When you're acting for a vendor, you ultimately put a contract and a lease forward, and it's up to the buyer to go ahead and to detail as much as they want. Obviously, there's some certain things that you need to disclose when you're selling a property, but we'd always guide sellers about that and tell them what they need to include and what they don't need to include. Because at the end of the day, there's no real end in sight. You can include as much or as little as you want for some people.
Yeah, I think, Scott, what we've determined from this podcast is the buyer's agents at the front end, they're all the sort of shiny Hollywood side things that everyone talks about, but the lawyer is the actual, the unsung hero of commercial real estate transactions.
Yeah, no, they're definitely underrated. And I know, like, a good lawyer, like, it's like when you're in business, you know, if it's all going great, you know, you don't really need your lawyers too much, but they're there when the chips are down. Like, if you've got a tenant trying to argue over something or defaulting, or, you know, you need that stern legal letter to send that, like, that's all the stuff that comes out down the track. And it's definitely not Hollywood. That's your sort of you're in the trenches type scenario, and a good lawyer will always help you out of them.
That's the idea. Well, Sam, thanks for joining us today, mate. It was good to chat.
Thanks for having us, Phil. Appreciate it.
And Scott, there's lots of questions that have been coming in, which we're sort of gluing all together. We'll get stuck in a bit of a Q&A episode. Some of it's pretty baseline stuff that people want some more education on, but we're getting a lot of sort of scenario type questions coming in as well. So we'll get stuck into them. Anything else you think we sort of plan for future episodes?
Well, I think probably getting a good accountant in will be sort of interest, because I'd like to sort of get someone to run through the Queensland land tax changes, which I'll let them explain how it impacts commercial and how tenants pay certain amounts of land tax or whatnot. So it affects commercial differently to residential, but that could be something good to go through now that that's flown through. And lots of questions. Like you said, there's a lot of people wanting to come onto the show, so we'll keep going through that. But yeah, I wanted to say as well, if anyone was keen to leave like an iTunes review, that'd be really good. My marketing team's asked us to do this just so it allows people to find the podcast easier as well. So if you get any value out of the show at all, really would appreciate if you could leave a review.
Yeah, that's Scott being nice. If you're tuning into this, you know, it's just me and Scott do the nice bit and have a bit of a chat. There's a big team who make us sound good or do all the heavy lifting around this, both within our team here, but also at Rethink. So they get a real kick out of that stuff coming through as well. So please leave those reviews wherever you're listening to it. Most of you on iTunes, and we do have a look at them. We sometimes do shout outs as well. So keep them coming. It just helps more people find what we're doing right here. And back to my original point, Scott, there's a lot more people now asking about commercial rather than resi. So let's see how it sort of continues through this market cycle. What happens at the back end of it, where we are in that market cycle, how far from the bottom are we? Who knows? But if you go and have a look at the history of real estate, well, you know, what document history of real estate, there's always inflection points coming off the back of seismic market shifts, and we're in that right now in terms of these interest rate hikes. So a lot of economists talking about it. Go and check it out. Maybe we can do a bit of a deep dive around that as well next time we get together, Scott. Yeah,
I think so. Deep dive into the economy side of things again. It's been about 6 months since we last did that. So I think it's all very important stuff for us commercial investors.
We'll jump into it. That's Scott O'Neill, co-host of Inside Commercial Property, director over Rethink Investing. Thanks for joining us today. We'll see you again next time. Until then, bye-bye.